Today we're going to talk about the destructive feedback loop that our stock market is caught in. And you're going to see in a minute here how this isn't just based in the US, it's actually a global problem because of what's happening right now. As you've known, over the last few decades, our global economy has become more and more connected, especially when we consider the central banks. Every country's printing money, they're all trying to stimulate their economies because most of them are always usually on the brink. And the last time we were probably talking about the foreign central banks was when we were talking about zero interest rate policy, where everyone was pushing their interest rates down to zero. And we all said, hey, that's a bad idea because inflation's going to come and you're going to get screwed. And that's exactly where we are now. Again, not only in just the US, but everywhere else too. The legendary Stanley Druckenmiller recently had an interview at the Sohn conference, and he said this is his 45th consecutive year as a chief investment officer. And in 45 years, he's never seen a constellation where there's no historical analog. I probably have more humility in terms of my views going forward than I've ever had. And this is Druck, the GOAT of investing. And he said he's basically never seen a market like this. So if you're struggling with it, don't worry, you're not alone. But let's dive into the research to see what's going on and why things are getting so bad. And as always, this research is coming straight from Macro Ops, our global macro research and consulting firm. So like Druck said, there are zero historical analogs for what we're experiencing today. And a historical analog is just something that you look back on to say, okay, this is how it played out here. It will likely play out the same way here. We know history doesn't repeat, but it rhymes. But in this case, we don't have that analog. So nobody actually knows where this bus is headed or what path inflation is going to take, or at what level yields will settle. Anybody who says otherwise is lying. But realistically, we don't need to be able to predict this, right? All we need to do is manage our risk and follow our process. And one critical part of our process is having guideposts. So our guideposts are basically data points that tell us what's probable so that we can continually update our views and correct them when they're wrong. So manage our risk. So a recent example of this is the short-term buy signal that triggered for us on May 23rd. Our systems told us that odds strongly favored a multi-week bounce in risk assets. Here, May 23rd, this bounce right here. And if you remember our previous video, we were thinking, hey, this is going to last a few weeks, but in fact, it did not, because that inflation print came out and just tanked us lower. So as I said, we got that bounce, but it was more short-lived than expected, and that's because of our guideposts. So one of our guideposts is US Treasury yields, and those failed to settle down and hold a ceiling, meaning bond prices kept falling, so yields kept going higher. And when yields or interest rates goes higher, what's that mean? Well, it's bad for equities. So when yields broke out again after that happened with the inflation print, it was an important guidepost telling us to go back to playing defense. So the market just the other day was down 4%, and the 10-year notes finished the day down roughly 1.25%. So we typically like to fade this type of fear, but actually what's going on now is not a healthy market. So the problem and the feedback loop that we're stuck in, the negative one, a very destructive feedback loop, is that stocks cannot bottom until yields slow their roll. Because what did we just say? Rising yields is bad for stocks, right? So yields need to stop rising for stocks to stop falling. But yields aren't going to settle down until we get visibility on cooling inflation. Because if inflation is running hot, that's when yields increase, right? Interest rates. But for inflation to cool, it's going to take a couple of months at least. And until then, the Fed is strongly biased hawkish. They have to be, because they have to try to match or exceed the market's expectations or risk easing financial conditions, which they can't afford. So by the time this video comes out, the Fed meeting will have already concluded. But right now, there's like an 87% chance that the market is expecting them to hike 75 bips. And that's most likely what they're going to do because, like we just said, they either need to meet or exceed expectations. They need to raise that interest rate so that they tamper down on inflation. But we'll talk more about that in a second. But what we got now between yields and stocks is a destructive feedback loop, because rising yields drive risk assets down, risk assets meaning stocks, which creates increasing alarm over high inflation levels, because everyone is like, oh, rampant inflation, that's bringing prices down. And that puts greater political pressure on the Fed to be more aggressive, which causes them to again raise rates, which will again cause stocks to fall. So really the key here is that inflation needs to calm down, because otherwise you're going to get yields that just continuously rise and stocks that continuously fall. See, the thing is, bonds are supposed to act as a countervailing force to stocks, kind of like a pressure release valve. So when equities get dumped, that money is supposed to flow into bonds. And when it flows into bonds, what happens? Yields fall, because that's how it goes, right? Bond prices up, yields down. Bond prices down, yields up. And we know if people are buying bonds and yields are falling, that's good for the stock market, right? Lower yields, better for stocks. So this establishes a floor under risk assets. So everyone dumps their stocks, floods into bonds. Bond prices increase, meaning that yields go down. Yields down, that's a positive for the stocks. So people can flood back into stocks, stocks go up, bond prices fall and yields go up, which once again, money can then flow out of stocks and back into bonds. So it's kind of a seesaw, right? They balance each other out. That's not working right now because of this inflation problem. So without that release valve, right, with the bonds balancing the stocks, we get air pockets like what's currently happening, why we're dropping so much. And that's why the feedback loop is so concerning. And unfortunately, like we said in the beginning of this video, it doesn't just stop in the US. This is happening globally. So if we look at the Bank of Japan right now, what are they doing? Well, USD JPY, which is the strength of the dollar versus the Japanese yen, it's over 4 standard deviations above its 200-day monthly moving average for the first time in its history. And the reason the dollar is becoming so strong compared to the yen is because the Bank of Japan is the last central bank that's still trying to control their yield curve. So the yen recently hit its lowest level against the dollar since 1998. And this is a problem when the dollar is becoming too strong and your home currency is becoming too weak, because Japan is a large net energy importer. So things like oil, coal, gas, they comprise over 20% of their imports, and all those goods are priced in USD. But now every yen is getting you less and less USD. So energy is now the most expensive it's ever been. You can check out this chart right now. It's not sustainable. Look at this. Going back all the way to the 70s. So the Bank of Japan meets this week too. And Japan's 10-year yield is bumping up against its 0.25% cap because they're trying to control it, right? And this is the first time it's happening since January 2016. And this matters for markets around the world because low Japanese yields have long acted as an anchor to those in the US. So you got to remember, markets are a relative game. Money flows to where it's treated the best. That's why we get money flowing from stocks to bonds to back to stocks again. And then on a global scale, money is going to flow to the country where the rates are the best, right? So it's all a relative game. So the price of one sovereign bond needs to be looked at in relation to the price of the others. So controlled and pinned yields in Europe and Japan have long kept a lid on those in the US. But inflation has forced the European Central Bank to abandon this ship called ZIRP, their zero interest rate policy. Inflation is too out of control. They gotta raise rates. And Japan is gonna be forced to do the same because their currency weakness and the crushing import costs will demand it. So again, they gotta increase their rates so money can flow back into their country. And here's something that people don't understand as well about currency. It still comes down to supply and demand. So when I say money flowing back into Japan, it's more of a mental model. Think, if Japan has higher interest rates, then people will want to put their money there because they're going to get a better yield on their investment, right? So if people are pushing money into Japan, what do they got to do? They got to convert it from their currency into the Japanese yen. That demand for the yen will push the value of the yen higher because if more people want a certain good, what happens? Price of that good goes higher. So if that happens, you can stem what's happening here a little bit. The dollar won't be so strong compared to the yen. The yen will get stronger. So this is another problem that we're facing in our destructive feedback loop with inflation and yields. It's affecting every country everywhere. But that's not all. The Eurozone is actually a potential flashpoint for all of this. Because what do we know about the Eurozone? Terrible idea. We have way too many extremely different economies and cultures all being smashed under one roof. It doesn't work, especially when it comes to monetary policy. See, European sovereigns can't print their own money because it's all euros, right? So that has to be done by the supranational entity, the ECB, the European Central Bank. So European Union member bonds are not default risk-free like US treasuries or Japanese government bonds. And when we talk about EU members, we talk about the individual countries. So in the US or in Japan, they're risk-free because those two countries can just print more money if anything happens. But these countries that are in the ECB, like Greece or Italy, their government bonds aren't risk-free because they can't print by themselves. They gotta go beg to the ECB to print for them. And that goodwill is conditional upon member countries maintaining certain debt and fiscal targets. Again, this is stuff that has been out of the news cycle for a long time, but the problems never went away. And now these same problems are coming back even worse because of this inflation thing and the interest rates. See, inflation is making both these conditions indefensible for a few countries, with Italy at ground zero of it all, once again. You all remember everything that was going on in Italy before. So the yield on the 10-year has risen from 2.9 to 4.10% in just the last 2 weeks. Spreads on bonds are quickly approaching their COVID wides. And the ECB, under its current legal mandate, can't really do anything other than continue to make things worse because they need to fight inflation. So the problem is that these rates are going to keep getting pushed higher, and Italy quickly becomes a default risk, despite everything they've done over the years to avoid it. The inflation and the yields that are rising to combat it are just killing these smaller countries. So this is a big reason the Western powers are working so hard behind the scenes to try and get a ceasefire in the Russia-Ukraine conflict, because they're desperate for anything to bring down the inflationary pressures, because we know what's coming and it's not good. Sustained inflation like this will ruin a lot lot of things. So there you have the destructive feedback loop between interest rates, inflation, stocks, and bonds. But none of the above is inevitable. The situation is dynamic and policymakers are more responsive than they used to be. So again, we don't need to predict here, we just need to be mindful of the developments that are happening and the expectations currently embedded in markets surrounding these developments. So right now what we're doing in the macro ops portfolio is just sitting on a lot of cash and doing research into things to buy when the dust begins to settle. Like right now our portfolio is 80% cash with risk completely netted out. So we have a lot of dry powder. Plus we're up 21% on the year right now. So what, that's like 50% better than the NASDAQ. So we don't want to give much back trying to trade a high noise, low win environment. If we get a big multi-week rally in risk assets, then we'll be more interested on pressing on the short side. But at these levels right now, it's just tough. And I know one of you were asking about this, like why aren't we just shorting? Because shorting in general is extremely tough. But it's especially tough in this situation because you don't want to short while we're already in the hole. You'll get your face ripped off in a bear rally, which is never fun. Like depending on how this Fed meeting goes, we could have a massive rally. And if you were short going into it, you get screwed. When things are so bad, any little piece of news that's even less worse than expected or even a little good, that's going to cause a big reaction in the market, and that's where your shorts get blown out. So that's not the right way to short. Really, how you want to short is when the market is rebounding, but your general macro view is that we're still headed lower. So you kind of short on the way up so that when it turns around, that's where you make the money. So even position sizing on a short right now is just too difficult. The one optimal short still seems to be in the crypto space. The crypto markets will be dead money for years. The correction there is just getting started. So we got a big Ethereum short right now that we're gonna keep adding to. But honestly, one of the best trades we could all put on right now is picking up a hobby or taking a trip. That's what Druck is doing. He said, I'm waiting for a fat pitch. I wanna be fresh. It's been a lot of activity in the last 4 to 5 months, so I'm in no hurry here. I'm in the marathon and I'm not running full out on mile 16. And that's what we talked about in the last video. Don't fight this downtrend. Don't fight the flow, because the more you do it, just the more pain you're gonna be in and you're not gonna get anywhere. You gotta go with the flow. And if you do wanna do something in the market, then do research, learn. Right now, we actually got the Macro Ops Collective open. And I'm gonna put a link to it in this video and down below in the description and comments. I think it's open until Sunday for enrollment. But the Macro Ops Collective is where all this good research comes from. And what I share on the channel is only a portion of it. But we've got a ton of education in there. We got the private chat forum on Slack, where you literally have people managing hundreds of millions talking in there. We got a whole bunch of educational stuff and we're constantly adding more. There is a fire hose of research coming, and that's how we're able to be up 20% on the year. And now is a great time to get into macro because I know a lot of you guys are really interested in this stuff. And fortunately, there are a ton of smart people in our group. It's a really awesome community that we built over the last 7 years. So definitely click the link and you'll be taken to this page where you could read all about it. To be honest with you, what we're seeing for the next 10 years for equities is probably going to be pretty rough. Buy and hold will for sure not work. Momentum should still work, but macro is where the big returns are going to come from. Like a lot of the returns right now are in the commodity space. They've been there the whole year. If you've been playing in the equity markets, you haven't been making much. So now is a great time to get started learning. We got some great stuff coming at the end of the summer too, but I think you guys are really going to love it. So definitely check it out. And once you check out the collective, make sure you watch this video about anti-capitalism and how it's becoming a big trend in this bear market. So check out the collective, click this video, and I will see you there.